Hey guys, it's Stan here. Today we're gonna talk about how companies reduce their financial risk using hedging. So in this video you will learn exactly what financial risk is, how a company can estimate its exposure to this risk, and what strategies you can implement to reduce your financial risk. So let's get started. First, let's define what is a financial risk exactly. Well, actually it's pretty simple to understand. It's everything which is related to a price fluctuation, because price fluctuation, especially for a company but also for an individual, means some kind of uncertainty, so some kind of risk. So there are three types of financial risks I have listed here. First of all, let's start with commodities. Commodities are, for example, oil, aluminum and steel, and they are listed on commodity exchange platforms or commodity tradings. So these prices fluctuate on a daily basis. So that's the first risk. The second risk is the FX risk, which stands for foreign exchange, which is the risk when you convert one currency, for example euro, into US dollars. And the last risk is linked to interest rates, especially if they are variable, because variable interest rates depend on the central bank and they depend on the market circumstances, so they will also fluctuate on a daily basis. So these are the three risks you have to watch out. And now I'm gonna give you an example, so it's gonna make a lot of sense why. Okay, now let's jump to our example. So imagine an international airline which is based in the United States. When you look at the risks, the different risks we just talked about, you will see that an international airline has all the three risks here. First of all, look at the biggest variable cost of an airline. To make a plane go from A to B, you need a lot of kerosene, which is basically oil. So that's your biggest variable cost. So the kerosene will depend on the oil price, which makes it a commodity risk for you. Then second of all, an international airline obviously sells a lot of tickets and has a lot of operations in many countries, which means let's imagine my US airline here is selling tickets in Australia. The clients will pay them in Australian dollars, and at some point they're gonna bring the money, they're gonna convert the the Australian dollars to US dollars, which gonna make it an FX exposure or an FX risk here for them. And third here, this international airline has a lot of debt to finance its activity, and now let's imagine it's a variable debt, which means they have variable interest rates. So as I just explained, the interest rates, when they are variable, obviously they go up and down, which means they have the three risks combined here. So now let's look at the exposure this company has, and let's see what we find out and what we can do to reduce the financial risk. So now before we look for a solution, we should really understand the problem here. So what is the issue? In this case here, kerosene, so the oil price, is a commodity risk. And why is it a commodity risk? Because it depends on the oil price fluctuation, and as we all know, it's going up and down and up and down, and it's very difficult to predict here. So here we definitely have to do something. Then for the second case here, where I'm selling tickets and have operations all over the world, that's a foreign exchange risk, because at some point, and think about my Australian client here, he pays me in Australian dollars because he lives in Australia and buys a ticket in Australia. But at some point I need to bring this Australian dollars back to my home country, and here my home country is the United States, so I need to convert local currency, in this case Australian dollars, into US dollars. That's my issue here. And last point here, I have a variable debt, which means I have variable interest rates here on my debt. So the problem obviously here is the whole interest fluctuation, because as we all know, the interest rates are also going up and down, so here we need to think about a solution as well. Now that we have localized the issue, we have to ask ourselves, where will the issue impact our financial statements? Will they impact our financial statements or not? And if so, in which financial statement? So let's go line by line. You will see that here talking about costs, because the price of the kerosene going up and down will have a direct impact on your cost structure, and your costs, you will find them in your profit and loss statement, so in the P&L. So here when you're looking at the financial statement impact for the first line, it's going to be in your profit and loss statement, because we are talking about cost fluctuation. Second line, we're talking about a foreign exchange risk. That's typically going into your cash flow. It has nothing to do with cost here. It is related to the change of currencies. Let's say if one day $1 US dollar equals one Australian dollar, you will have zero impact. But if it changes, you see that in your cash flow you will get less or more if the currencies in between change. So here we have a cash flow risk. And in the last section here, we have an interest rates risk. So the question, the issue here was a variable interest rate, and as we all know, the interest rates go into your P&L at the bottom of the P&L. So here the financial statement impact is the P&L. So now I know, especially if you're not a finance guy or something like that, this can be a little bit complicated. I made an entire video about it, which is called How to Read Financial Statements for Dummies. It's about half an hour long, and it's going to help you to understand how the different financial statements work. If you're struggling with it, I put it here, and I also put it in the link in the description below. So make sure to check this one out if you need help here. So let's move on to the next section. So now it's time to introduce you to two new concepts. First of all, there is the transaction risk, and second of all, there is the translation risk. So what's the difference between both of them? The transaction risk is directly related to cash, and translation risk is directly related to accounting. So that sounds a bit theoretical, that's why it's going to be much easier in the example, but keep that in mind. And now think about the different lines here. The reason why we have structured it like this is to classify both risks here. As you can see here in the first case, where the oil price is the big factor, or the fluctuation of the oil price, our financial statement which is impacted is the P&L. So now we know, since it's the P&L, it's gonna be an accounting issue if you want, so it's gonna be a translation risk in the first line. Second line, we're talking about the foreign exchange risk, which is convert local currency into US dollars. That's gonna be the tricky part. And here you can see it has nothing to do with accounting, it's pure cash, right? You are converting one currency into another, it has nothing to do with accounting, it's pure cash. So here the second line is obviously a transaction risk. The third line is related to interest rates. The interest rates, as we just discussed it, they go into your profit and loss statement, so it's gonna be a translation risk because it touches your accounting. So now that we have talked about transaction risk and translation risk, we will move to the next section. The reason why it's important to localize if it's a transaction risk or a translation risk, and the impact on which financial statement it will have, is because your strategy to reduce risk, which is called hedging, so your hedging strategy will be different using different hedging tools if you have a translation risk or a transaction risk. So it really depends, is the risk only related to your cash, or is it also related to your accounting? That's what we're going to find out, and now let's look at the strategy we can have here. It's time to introduce you to two other concepts, which is the difference between natural hedging and synthetic hedging. That sounds super complicated, but actually it's not that hard to understand. Let me explain it to you right now. So natural hedging is related to your cash flow and especially to FX risk. So now let's walk to this example and you will understand the thing. Here in our cash flow, let's think about our airline who sells tickets in Australia, for example, and let's look at their cash flow. Imagine I'm a US airline. I just made a sale of $100, cash in coming in $100, 100 Australian dollars, and I have cash outs of 60 Australian dollars, which means that for my Australian business, I have a net cash per month of 40 Australian dollars. And in my company strategy, I decided that at the end of the month, since I am a US business, I'm gonna send these 40 Australian dollars into my US dollar account. So here I'm switching 40 Australian dollars into US dollars. So you see that here I have a pretty big FX risk because I do not know the conversion rate. It's going to change each time. And why do I do that? Because, well, my business is in the United States, so I want all my currency to be in the United States at some point because, for example, paying back a loan in US dollars. So that's the starting point. Now let's look at natural hedging and what we could do here without using synthetic hedging. So the goal here of natural hedging for foreign exchange risk is to reduce the net cash of a country. So let's say in this example, I need to find a way to increase my cash outs so that my net cash here becomes less. Because if I have less at the end of the month, I don't need to convert too much into my US dollars here. So how can I have less Australian dollars at the end of the month? For example, and I've seen that in a company, here you see that the company is paying back a bank loan in US dollars. This company could decide, okay, why are we, if we have a big activity in Australia, why are we not splitting that US dollar loan into Australian dollar loan and into US dollar loan? So the company, instead of paying back one loan, they would pay back two splitted loans, one in US dollars and one in Australian dollars. Because the idea here is actually you would, since you would pay back interests here, you would increase, and principal as well, you would increase this portion of cash outs and therefore decrease the net cash in Australian dollars, which means that at the end of the month you would have to convert less into US dollars. So that's how you can reduce your FX risk here, just by using natural hedging, which means in this case I created a loan, a bank loan in Australian dollars, so in my local currency here, which means at the end of the day I have less net cash in Australian dollars, which means I have to convert less into US dollars. So that's the idea of natural hedging. Now let's move on to synthetic hedging. So synthetic hedging means that I'm gonna use and buy some derivatives which are financial instruments. As you can see here on the left side, when we did the natural hedging, we did not buy any instrument. We just converted or splitted a loan into a local currency, which helped us to reduce our foreign exchange risk. Here in this case, synthetic hedging means we're buying some tool that's gonna help us reduce our risk. I don't want to get too much into details because next week I will make a special about these 4 products here to make it very clear. This would be too long today, so just to give you a brief answer here, it's what are derivatives? Well, they are financial instruments, contract that's gonna allow you to bet on future prices. And actually you have 4 categories of derivatives, which are futures, forwards, options and swaps. Now that we quickly saw what natural hedging is and synthetic hedging is, we can look back at our example of the airline and see how we can implement it here. So now when we look back at our airline example, you remember that we had 3 issues. First issue was that we had oil price fluctuation. We are an airline, we have a lot of costs related to oil. We would like to hedge our risk when it comes to oil price fluctuation to control the costs for next year. Second problem was our foreign exchange exposure. As you remember, we are an international airline, which means that we have businesses all over the world and customers and businesses paying us in local currencies. We are US based. And the third one was that right now we have a variable interest rate on our loan, so now we can look at our hedging solutions. Back about the impact, oil price fluctuation is a cost issue, which means it goes into your P&L. So here you have a translation risk, an accounting risk. In the second line here, FX exposure, you have a cash flow risk, so a transaction risk when you convert one currency into another. And in the third line here, your interest rate, especially a variable interest rate, will go into your P&L on the bottom, which means you're gonna have an accounting issue, so a translation risk. So now let's look at my hedging solutions here. We just talked about the difference between natural hedging and synthetic hedging. Now let's see how we can implement it here. Here I would go for synthetic hedging because we cannot do much when it comes to natural hedging, because we have absolutely no control about the cost of the fuel in the future. So the only way to reduce your financial risk is to buy some derivatives. In this case, I would buy a fuel option. An option is pretty good because it gives you more flexibility. You pay more, but since there is so much uncertainty right now and you have absolutely no clue what's going on with the oil prices in the future, an option gives you the option to buy at a certain price or not to buy and go with the market standard. So that's why I would go with the fuel option here. Second point, FX exposure. We have discussed it previously in the example here. I would use natural hedging, which means here, let's say I have a big exposure in Australian dollars. I would create a loan in Australian dollars to offset the Australian dollars I need to convert into my US dollars. So that would be my point here. And in the third line, I would go for synthetic hedging, because in this case, actually you do not have so many options here when it comes to interest rates. When you want to change a variable interest rate into a fixed interest rate, let's say because it's very interesting right now, the interests are super low, so you want to fix these interest rates that you currently have. So the only option you have here is basically an interest rate swap, which means that your variable loan will become a fixed interest loan, and this is what you want when the interest rates are low as right now. So these were my 3 hedging solutions. Yeah, I wanted to tell you something very important as well. Hedging or not hedging, there is no right or wrong. It's purely a subjective decision you have to make, because it will depend on your risk awareness. So let's say if your CEO or if your board definitely want to hedge because they are very uncertain for the future and they want to fix and to make it less volatile for the future, then hedging is definitely a good option. And then obviously you have a lot of things to consider. But there are a lot of companies like Apple which are huge and have a lot of international business. They decided not to hedge because it was purely their decision. They said, okay, we can take the risk for the future, let's do it without hedging. So that's also an option. So hedging is not a must, but these are definitely solutions that can make you sleep better in the night after. Obviously it depends how much you want to pay for this, because hedging costs you something. So it's always going to be a calculation between, okay, how much certainty or uncertainty can I afford, and how much hedging can I afford as well. Next week I will talk in detail about the different tools, for example, options, forwards, futures, swaps. So make sure to subscribe, make sure to like if you like this content, and I post once a week every Sunday, so make sure to stay tuned. See you soon on the channel. Bye bye guys.